This video contains synthetic content which has been approved by Rick Kimberley and RSM Australia. With that out of the way, welcome to our Global Employer Services update for the month of March 2025. In this video, we will cover updates on superannuation, payroll tax, fringe benefits tax, and pushes to select changes to industrial awards. The Case Commissioner of Taxation, v. Hatfield Plumbing, highlights the complexities in distinguishing between employees and independent contractors, particularly in the context of superannuation obligations. This case revolves around whether Mr. Hargreaves was an employee under Section 12(3) of the Superannuation Guarantee Administration Act 1992. Mr. Hargreaves complained to the ATO that Hatfield had not made superannuation contributions on his behalf. The ATO determined that Mr. Hargreaves was an employee under Section 12(3) of the Act and assessed a superannuation guarantee charge of $123,521.77. Hatfield submitted an objection to the ATO that was denied, following which it applied to the tribunal for a review. The tribunal concluded that Mr. Hargreaves was engaged to produce a result, not simply to provide labour, and thus was not an employee under Section 12(3). The Commissioner then appealed the finding of the tribunal. The appeal focused on whether the tribunal improperly conflated the common law test for employee with the statutory test under Section 12(3). The tribunal found that Mr. Hargreaves worked under a verbal agreement, used his own tools and vehicle, and was paid on a due and charge basis, where he had the freedom to accept or reject jobs, set his hourly rate, and worked independently without supervision. The federal court upheld the tribunal's decision, agreeing that the tribunal correctly applied the law, and the appeal was dismissed, with the tribunal's decision that Mr. Hargreaves was not an employee was upheld. Payday Super is a major change to the way superannuation guarantee payments are processed for employers. This long-awaited draft legislation provides some answers and also leaves some questions. Currently, employers are required to make superannuation guarantee (SG) contributions for their employees on a quarterly basis. However, the Federal Treasury has released draft legislation, broadly scheduled to commence on the 1st of July 2026, which will rewrite the superannuation guarantee framework. The core of Payday Super is a move to more frequent contributions. Under the proposed law, employers will generally be required to make superannuation contributions to their employees' funds within 7 calendar days from when salary or wages are paid. This shift to more frequent payments has several potential benefits. For employees, it means superannuation contributions will be received earlier, allowing for more compounding returns. For employers, while it requires more frequent processing, it can lead to smoother payroll management and prevent the build-up of large superannuation liabilities. Under the new framework, the calculation of superannuation obligations will be based on qualifying earnings, which will generally align with the current ordinary times earnings (OTE) base. The maximum contributions base will also change, moving from a quarterly to an annual application based on the concessional contributions cap. It's crucial for employers to meet their obligations to avoid liability for the SGC. These primary obligations include paying the required contributions on time, which is within 7 calendar days after the payment of qualifying earnings. There are some exceptions to this 7-day rule, such as for new employees who generally have an additional 14 days, contributions to stapled funds that are initially rejected, allowing up to 42 days, and out-of-cycle earnings like bonuses or commissions. If an employer fails to make timely contributions and incurs an SG shortfall, the calculation of this shortfall will be revamped. It will include an individual final SG shortfall, an individual notional earnings component, similar to the current nominal interest, an administrative uplift amount, and any applicable choice loadings. Importantly, the Commissioner of Taxation will be able to assess an SG shortfall unilaterally using data from sources like single-touch payroll and superannuation fund reporting. To encourage compliance, the draft law introduces an innovative remission regime for the administrative uplift amount. This uplift, initially set at 60% of the shortfall and notional earnings, can be significantly reduced based on factors like whether the Commissioner has previously made a unilateral SGC assessment, and crucially, whether and when the employer lodges a voluntary disclosure statement. For instance, a voluntary disclosure within 30 days of the QE day, coupled with no prior Commissioner-initiated assessments in the past 24 months, could result in a zero administrative uplift. This strongly incentivizes proactive governance and the prompt correction of errors. In terms of tax deductibility, the new framework brings good news. Both on-time and late superannuation contributions, as well as the SGC itself, will be tax deductible. However, any general interest charge or late payment penalties related to the SGC will not be tax deductible. Payday Super represents a fundamental shift in how superannuation contributions are managed. While the draft laws don't explicitly address the impact of public holiday periods on the 7-day requirement, the Commissioner does have discretion to authorise extensions in exceptional circumstances. The commencement of Payday Super offers employers an incentive to start with a clean compliance slate. Therefore, it's vital for organisations to begin planning now to implement robust processes and controls to meet these new requirements, reviewing their onboarding, system configurations, and remittance frameworks. The Commissioner has released a decision impact statement to provide the ATO's interim response to the Federal Court's decision in the case of Toowoomba Regional Council v Commissioner of Taxation. The case concerns whether a shopping centre car park qualifies as a commercial parking station under the Fringe Benefits Tax Act. Justice Logan examined the meaning of the word commercial within the context of the FBT Act and concluded that commercial implies an intention to make a profit, but that the Toowoomba Grand Central Shopping Centre car park's primary purpose was to complement the shopping centre's operations, rather than to generate profit independently. The interim decision impact statement outlines the ATO's position following the Federal Court's ruling that the Grand Central Shopping Centre car park is not a commercial parking station. The ATO has appealed the decision and will continue to follow its existing guidelines until the appeal is resolved. The ATO has stated taxpayers should continue to lodge their FBT returns based on the current ATO view. The Victorian Chief Commissioner has released Revenue Ruling PTA 042 to clarify the meaning of a regional employee and employer. For context, Victorian regional employers may be eligible for a reduced payroll tax rate if at least 85% of their total taxable wages are paid to regional employees. This 85% threshold applies both monthly and annually, though meeting the annual threshold negates the monthly requirement. A regional employee is someone who performs services for the employer, mainly more than 50% of the time, in regional Victoria. For remote work, the employee's home location determines if they are regional. Employers need to keep records to prove their regional status. The ruling provides examples to illustrate these definitions. Last year in September, the New South Wales Supreme Court handed down its decision in the matter of Uber Australia v Chief Commissioner of State Revenue. It found that Uber was not liable to pay payroll tax on payments made to drivers using its platform. In brief, the court found that drivers supplied services to Uber, resulting in a relevant contract as defined in the Payroll Tax Act. Specifically, the three activities of driving, rating and referring, either on their own or in combination, were concluded to be services, and those services were viewed as being for or in relation to the performance of work. The court accordingly considered the application of the relevant contract exemptions, with the majority of these exemptions being rejected, both from a technical perspective and due to lack of evidence. The court then considered whether the payments made by Uber were for or in relation to the performance of work. Although a relevant contract was found to exist between the driver and Uber, Uber was not making any payments to the driver. Instead, it was actually the rider who made payments to the drivers. And Uber's role in the arrangement was in a capacity as a limited payment collection agent. On this basis, and having regard to the contractual terms and the purpose of the contractor provisions, the court concluded that payments were not for or in relation to the performance of work. This resulted in an $81 million payroll tax reduction. The Commissioner appealed this judgment, and several weeks ago the appeal was heard. Uber argued the intention of the payroll tax provisions was to level the playing field between those paying and those seeking to avoid the tax, not to impose payroll tax on service contracts that bear no resemblance to a traditional employer-employee relationship. To that end, Uber argued it was a mere lead generator, connecting drivers with riders, and a collection agent for the money paid by rider to driver. In written submissions, the Commissioner of State Revenue argued that payments from Uber to drivers were deemed wages for the purposes of the Payroll Tax Act. If the driver did not drive a rider, there would be no money which Uber had to pay to the driver. Accordingly, There is a direct or indirect relationship between the payments to drivers and the work of driving. The Commissioner cited Thomas and Nas, the case that extended payroll tax to doctors working in medical centres, to argue that provided payments are work-related, they are liable for payroll tax. The judges expressed skepticism about Uber's argument, suggesting that the company's operations are more structured and integral to the business than merely generating leads. The court has reserved its judgment on the appeal. The outcome of this case could have far-reaching consequences for the gig economy, potentially leading to significant payroll tax liabilities for companies operating under similar business models. The decision will be closely watched by various industries and could prompt legislative changes to address the evolving nature of work in the gig economy. Employers, represented by the Australian Industry Group, AI Group, and Business New South Wales, are pushing for changes to the Clarkson Banking Awards. The Australian Industry Group proposes a 125% exemption rate, meaning workers earning 25% more than their award rate would not be entitled to penalty rates, overtime, and other award conditions. Business New South Wales proposes a 155% exemption rate for mid-level managers earning $85,000 or above, allowing overtime after 50 hours a week. Employers argue that current award requirements are outdated and do not reflect the flexible nature of modern work arrangements. Unions strongly oppose the proposals, arguing they undermine worker rights and protections. Finance sector union and Australian Services Union leaders criticised the proposals as a tax on workers' pay and fundamental rights. Recording hours for salaried workers has been a long-standing issue, exacerbated by the increase in work from home. The case is set for directions in September, indicating ongoing discussions and potential changes in industrial relations regarding working from home and penalty rates. Thank you for joining our update for the month of March 2025. We can see a lot of update for fringe benefits tax for the 2025 financial year. We recommend employers checking the new updates on the legislation on the upcoming fringe benefits tax lodgement. As always, please feel free to connect with your local RSM contact, being myself and Peter in Melbourne, Gina and Neve in Perth, and Jason in Sydney.